Hello, today I have with me Hugh Sergeant, who manages a number of the River Mercantile funds, which includes the UK Recovery Fund that appears in the Interactive Investor list of rated funds. Hello, Hugh.
Hello, good afternoon.
Now, Hugh, a glance at the top 10 holdings in the UK Recovery Fund, it throws up lots of household names, and among them are three banks, HSBC, Barclays, and Lloyds. Now, the sector has struggled ever since the financial crisis, really. It's had its ups and downs since then. What's your view on the banking sector currently and its recovery potential?
Yeah, I mean, as value managers, we've not given up on banks. I think a lot of other fund managers essentially have, but we haven't. We've held an overweight position consistently for the last few years, but we've not wanted to overly expose the portfolio to this single sector or single theme, which is, companies that are potentially exposed to a pickup in inflation and interest rates. So we've been overweight, but not aggressively overweight. Where we are today, banks are clearly universally hated, but we do think they will start to perform. First of all, they're very lowly valued, so typically they're trading at half their book value, their tangible book value. And if you look at earnings multiples, low single-digit earnings multiples in terms of recovery profits. They are coming out of the COVID crisis with their balance sheets apparently very much intact, so very, very strong. So if you look at Lloyds, for example, a lot of free capital, and they continue to grow the amount of free capital, so that's great. And then they're actually starting to grow again, so there's quite a lot of demand for mortgages in particular, so they're seeing that part of their lending book grow, and then we've got the potential catalyst of a return to dividend payments, probably into early in the new year. That should be signed off, so that could act as a catalyst. So yeah, very low valuations. The outlook is a lot better than those low valuations would suggest, and some potential catalysts coming up over the next quarter or two.
Sure, and I mean, you talked about Lloyd's a bit there as well. I mean, people have been waiting a long time for Lloyd's to. There have been lots of false dawns, and obviously, people want to know when there will be this sort of sustainable recovery, I guess, at Lloyd's.
I mean, it's probably fair to say that it's unlikely that banks will return to their former glories pre the global financial crisis, just because we're in the background is one of such low interest rates that it's really quite hard for them to make a sensible or as high a return on their capital as they might have done in the past. Maybe if you look forward 5 or 10 years, when we've had a much more reflationary environment, when interest rates normalize, and they could make really attractive returns on capital and return to former glory. But even if they don't return to former glory, then I think they're very sensible investments at this point. Lloyd's profits will recover over the next couple of years. Dividends will be reinstated. They should be able to grow in certain areas such as mortgage lending and the wealth side. And the shares should be at least able to trade at a premium to their book value, and that would suggest from here, the shares doubling just to get back to book value. So yeah, should be attractive investments from this point.
Okay, I mean, of HSBC, Barclays, and Lloyd's, which of those three has the most recovery potential, would you say?
I think a combination of Lloyds and Barclays. HSBC has always been more of the kind of steady Eddie global. I mean, it's not really been that, but it still reflects that a little bit in a higher valuation, not quite as discounted as Lloyds and Barclays have become. So from that kind of perspective, that recovery perspective, those two probably have more upside from a recovery perspective.
Sure. Okay. And also moving to another sector, unloved at the moment, oils and Shell and BP. Now, I mean, investors might be tempted to buy at sort of what are knockdown prices. I mean, what's your outlook for the oil sector and what are two very widely owned stocks?
Yeah, I mean, we do own both of those stocks in our portfolios, in a recovery portfolio. They're obviously big constituents of the UK benchmark, and I don't think would be underweight versus the benchmark. But we do think, they have significant recovery potential. They are very modestly valued versus their potential profits, cash flow, and historical valuation levels. And would expect, in the scenario that I've painted, of economic recovery into next year and the following year, you would expect in that type of environment the oil price to be relatively firm from the current levels. So taking all that into account, you would expect energy stocks to respond quite positively. I mean, obviously, the other aspect that everyone's having to take into account is the sustainability element of investing, and then clearly, energy stocks are at the forefront of that. So you need to clearly understand how those companies are, going to reposition their franchise over the medium term to focus on as much on the renewable side as the carbon production, or at least getting a degree of balance. So you need to have confidence in that. But I think BP and Shell have started to articulate, relatively clear passage to more sustainability.
Then we've talked a lot about some large caps in your portfolio, the UK recovery portfolio, but there are some interesting small caps as well. Impact Group, Gresham House, Somero Enterprises, Echo, Boku. I just wonder whether you could talk us through some of your favourites.
Yeah, I mean the recovery strategies have always had pretty significant exposure to smaller companies. They're very much multi-cap approaches, and you can find some real bargains in small cap end of things because of a lack of coverage and also because of illiquidity. So when they come out of favor, they really go out of favor at the small cap end. I mean, you've mentioned one or two. I might just highlight one, Somero. So this is a business that we've followed for quite a few years. It has a cycle, so we were particularly aggressive buyers of it, during the global financial crisis, and now is another interesting point to be buying the shares from our perspective. The business is actually a world leader. It's a kind of micro cap, but it's a world leader in kit that levels concrete, but really sophisticated leveling, as flat as you can get. And you need this for in particular for some of the big warehouses being put up for e-commerce. So you think of an Amazon, for example, they would need their contractors to be using Somero kit. So it's got a great leading global market position in that, but it is cyclical. If it follows the construction cycle, it's particularly strong in the US. So we've seen a little bit of a downturn during the pandemic, and that's meant the share price has reflected that downturn, and the shares are available on a really attractive recovery earnings multiple. And one particularly strong aspect of the business that it generates a huge amount of cash, so it doesn't need to invest in capex significantly. Makes high gross margins, high net margins, little capex required, equals a lot of free cash flow generation, most of which has been paid back to shareholders. So, and then you've got the recovery in terms of the construction cycle to look forward to in the US in particular as we go into 22. So that's one of our favorite stocks, small cap stocks at the moment.
Great. Hugh Sergeant, manager of the River Mercantile UK Recovery Fund. Thanks very much for joining us today.
Thank you very much, and good afternoon.